All right, today we're digging into a really interesting one from an investor's perspective, a Spanish industrial firm called Nicolas Correa. Now, this company presents a classic puzzle. It looks like a high-quality business, but it's trading at a surprisingly low price. So let's unpack that.
Okay, so let's get right into the puzzle. Just look at these numbers. Nicolas Correa is trading at roughly half the valuation of its competitors. You see it in the EV/EBITDA, you see it in the PE ratio. But, and this is the crazy part, its profitability, that EBITDA margin, is way higher. And to top it all off, while its peers are carrying debt, Nicolas Correa is sitting on a big pile of cash. You know, this is exactly the kind of disconnect that gets an investor's spidey sense tingling.
And that right there, that's the big question, isn't it? Has the market just totally overlooked a fantastic business, making this a hidden gem? Or is there something lurking under the surface, a good reason for this cheap price, making it a classic value trap? To figure that out, let's build the case for both sides, starting with the bulls.
First up, the bull case. The whole argument here is that Nicolas Correa isn't just another industrial company. The argument is that it's a truly high-quality business protected by a strong competitive advantage, what investors like to call a moat. This is something that gives it a durable edge and keeps the competition from eating its lunch.
So, what is this moat made of? Well, it's really built on three powerful pillars. First, they have unique, patented technology that's just hard for others to copy. Second, you've got brand reputation. I mean, they've been around for over 75 years. Their name is basically shorthand for precision and reliability, which is a huge deal when you're selling machines that cost millions. And third, they're focused. They don't try to do everything. They aim to be the absolute masters of their specific niche.
At the very heart of that tech advantage is this thing right here, the UDX milling head. This is the company's secret sauce. Its patented system allows for a level of precision and speed that is just incredibly difficult for competitors to match, especially the low-cost guys. This isn't just a minor tweak. It's a real, genuine technological edge, and it lets them charge a premium for their products.
And you can see that moat in the numbers, clear as day. This 4 to 5%, that represents the extra profit margin that Nicolas Correa consistently earns over its rivals. In the tough world of industrial manufacturing, that is a massive, massive advantage.
And this financial strength, man, this is another huge piece of the puzzle. While their competitors are weighed down by debt, Nicolas Correa has what you'd call a fortress balance sheet. We're talking about roughly 19 million euros in net cash. That gives them incredible flexibility to invest right through an economic storm while their rivals have to pull back.
But that just brings us right back to the original question. If this company is so great, why is it so cheap? Well, let's flip the coin and look at the bear case, because the market is clearly worried about some very real, very significant risks.
The bear case really starts with geography. Look at this. Nearly 2/3 of the company's sales come from the European Union. And as you probably know, Europe's industrial sector is facing some pretty serious headwinds right now. We're talking slowing growth, uncertainty. This heavy dependence is without a doubt the market's #1 concern. And this isn't just some vague worry. You can see it in the forecasts. The European Machine Tool Association is predicting a sharp 7.5% drop in production this year, and then another 7.5% drop next year. I mean, for a company that gets most of its money from this exact market, that is a seriously scary chart to look at, and it explains a lot of the pessimistic price tag. But it's not just the weak economy they have to worry about. Nicolas Correa operates in a brutally competitive world. They're up against global giants with way deeper pockets. They face constant price pressure from low-cost Asian rivals. They're also taking on a big risk with a major factory expansion project. And, oh yeah, with 90% of their sales coming from exports, any big swing in currency rates could really sting. So, you've got a high-quality company that's staring down some serious headwinds. What's the plan? How is management responding? Let's take a look at their strategy, because they are definitely not just sitting on their hands. They are actively working to navigate these risks and build for the long term.
This quote, I think it captures their mindset perfectly. They are playing the long game here. The plan isn't just about surviving a downturn, it's about investing through it so they can come out even stronger on the other side by building a smarter, more efficient production base.
And when you look at their strategy, it's like a point-by-point counterattack on the bear case. They're expanding capacity not on a whim, but because they have a record order backlog they need to fill. They're making a huge strategic pivot to India to diversify away from slow-growing Europe. And they're doubling down on digital innovation to make sure the technological moat we talked about gets even wider and deeper.
So, all of this brings us right back to where we started. It's the classic investor's dilemma. We've seen the good, we've seen the bad, we've seen the ugly. How in the world do you weigh it all up?
When you lay it all out like this, the trade-off is just crystal clear. The bull case is all about the company itself, its superior tech, its fat profit margins, that fortress balance sheet. The bear case is all about the powerful forces outside the company's control, a slowing European economy and fierce competition. It's really a battle between a great company and a really tough neighborhood.
So the final thought is this. It really boils down to one question. Is Nicolas Correa's operational excellence, its superior tech, its profitability, its smart strategy, is all that strong enough to power through this really difficult environment? Or will the immense gravity of a macroeconomic slowdown just prove to be too much to overcome? That right there, that's the multi-million euro question for anyone looking at this stock today.